I hate teaching from my computer screen. I really do. I just would very much prefer to be in person with you guys. Okay, so when we talk about financial management, again, within the chapter, and I'm not going to go through all of the slides. The slide deck's posted out there on Moodle. This particular lecture is more about just presentation of information around finance. Nothing that we really kind of work through today is something that you're going to be formally tested on at the midterm. Okay, but it's important to kind of frame the rest of our semester. All right, so we're going to talk about the 3 questions that every financial manager must ask, okay, and must answer. We have already kind of gone through what those are. We're going to go through some of the forms of like what types of businesses and how they're organized and why some have advantages over others and why some have more disadvantages than others. We're going to talk about what's called the agency problem, okay? Conflict of interests is a huge problem within corporate America, right? Because when we get to this section, you'll see that corporate executives are generally compensated in a very specific way. I'm not going to spoil what that is, okay? But there is a way, a very easy way to kind of determine whether or not senior executives, call them the C-suite, CEOs, COOs, the C-suite, have delivered value, okay? But inherent in that are lots of conflicts of interest. Okay, so we'll talk a little bit about what some of those are. And then we'll talk about just kind of the financial markets and how companies can go about monetizing the value, the equity, the sweat equity, if you will, that they've put into the firm. Okay, so again, the 3 questions that the financial manager must ask and must answer are: what are the long-term investments the firm is going to engage in? How are we going to get the financing to pay for these long-term investments? Okay, and how are we going to manage these investments on a day-to-day basis? Right? You want one slide that kind of boils down what this entire semester is about? This is it. Okay. Everything that we talk about starting for today, but really starting next week through the end of the semester really involves these 3 questions. Okay. They get complicated, they get more challenging, they get more involved, but it all boils down to these 3 questions. Which ones are we going to do? How are we going to pay for it? And then how do we manage them going forward? Okay. So when we think about the different organizational components to the firms that you all will go work for in the future, depending upon the size of the company, okay, you could have an entire treasury department, which is essentially responsible for the cash management of a firm, okay, the credit management, managing our debt, managing how our cash is invested, the conversion of accounts receivable into cash, right? The financial planning department, so who sets the budgets? How do we provide management with the reports that they need to run the business? Again, remember, not necessarily, some of them may be purely GAAP related, GAAP accounting statements. Some companies run their business using GAAP statements. Most of them don't, all right? Capital expenditures, the whole department revolving around aggregating all of the possible projects that the firm is looking at implementing for the next year, figuring out how much cash is available to spend for capital expenditures, and then how do we allocate those funds to the projects that we have chosen to do, okay? And then we have a controller department, all right, which is really kind of the cost accounting, the financial accounting, the GAAP reporting, the taxes, okay? A totally separate department that deals with that, okay? If you're in a large enough firm, okay, you'll have 2 separate departments. One that deals with the controlling aspects of the firm and one that deals with the cash and credit aspects of the firm, okay? Typically, both of those 2 departments would eventually report up into the CFO, who then obviously reports up into the CEO and board of directors, right? So how do we, what processes do we have in the corporate world that allow us to kind of get answers to those three questions. And how do we use the departments that exist, the controlling department and the treasury department, to get to answers to those questions? All right. Well, when we think about which projects the business is going to take on, implement, right? The capital budgeting team is responsible for that. Okay. So when we think about the New Heritage Doll case that we're going to talk about in week 4, they have a capital budgeting department that came up with how much these projects were going to cost. Okay. And they came up with the required rates of return. So there are departments that exist within the corporate structure that deal specifically with budgeting, capital budgeting. How are we going to spend the hard-earned cash, right? We worked really hard to sell product. We had good supplier contracts, so our gross margins are high. We did a great job managing our costs, right? And we've got this thing called operating cash flow, right? We've worked really hard to maximize operating cash flow. We don't want to just waste our money on projects that aren't going to deliver value to the firm. So the capital budgeting team is responsible for determining what long-term investments we're going to take on, right? And then the question becomes, all right, here are the projects that we want to do. Now, how are we going to pay for it? Right? Do we just pull it out of existing cash? Right? Do we finance some long-term projects with debt and equity? If you're going to go build a power plant, right, you probably don't have enough cash sitting around to spend $500 million to build a gas-fired power plant. Okay, so you've got to go access the debt markets. Okay, but what's the most efficient way of accessing the debt markets? Should we have this balance between taking out debt versus taking out equity? Do we issue more stock, right? We can bring value into the firm. We can generate money for the firm, right, by issuing more stock into the market. Okay. Or we can go to the bank and take out a loan. What's the right balance? Okay, so the capital structure, the treasury department, right, the cash management side of the business is kind of responsible for figuring out, do we use equity? Do we use debt or do we use equity? Okay, to pay for these projects that are going to deliver value to the firm. And then finally, once we've decided all of those and we've implemented the project, right, those projects cost money to run. Okay. Maybe we've implemented a project that put a new, like the New Heritage Doll case. They had to put in a brand new manufacturing line to expand their business. Well, that manufacturing line comes with people, right? You have to pay people to now run this new line. Okay, that's called working capital management. We delivered value, we added value to the firm, but that value that we added comes along with regular cost. Okay, and that's what we call working capital management. Current assets minus current liabilities. So as we move through and progress between now and the midterm, right, we're going to kind of go through some different iterations of these three questions, right? We're going to first start with looking at the firm as a whole. Okay. The firm has $1 million of sales. The firm has $500,000 of operating expenses, right? But the firm isn't necessarily one entity, right? If you look at a company like, I don't know, pick a company, Netflix, right? Netflix at the parent company level, what gets reported to Wall Street and the stock that you can buy, right? NFLX, right? But within Netflix, you've got different divisions within Netflix, right? You have the movie production aspect of Netflix. You've got the television production aspect of Netflix. You've got the content delivery aspect of Netflix. And each one of those will have different projects that they're looking at implementing to deliver more value to Netflix and their shareholders for the next year. So as we move from next week to the midterm, we're going to start with the firm as a whole, but then we're going to start looking at a smaller division that's evaluating a single project and how that single project is going to deliver a certain amount of incremental value over what the firm is currently doing. Okay, so when we talk about forecasting and budgeting, we're going to talk about it at the project level. The project will deliver 10% more revenue than what the firm delivered last year. And we'll talk about how all that functions. Okay, because at the end of the day, when we get, I hate that saying, I apologize. When we get to the midterm, all right, day 2 is about choosing one project or another project. Okay, and so project valuation is very, very important. Okay, what time we got? Ooh, what time is it? 11:50. All right, we got time. Perfect time. Okay, so within the US, there's basically 3 major forms of business organization. And some are a whole lot easier than others to actually get started. Sole proprietorship being the easiest because you really don't have to do anything. If you just decided you wanted to start a sweater knitting business, you could do that, and that would be a sole proprietorship. Right? And we have partnerships, right, where we kind of get into bed with other people. And with general partnerships, those are the guys that are responsible for like managing the day-to-day operations of the business that we get involved with them in. Okay. And then within the general partnership, you know, you basically have unlimited liability. If you're running the business on a day-to-day basis, then you assume all liability. And then within that partnership, there's also probably some limited partnerships where people are willing to invest within the business and they give you money in the form of equity, right? But they don't have a say in what goes on, right? They're silent partners. They don't run the business on a day-to-day basis. So they're limited partners. And their liability is really only limited to the amount of equity that they have remaining within the business. Okay, so if I invest $1 million in a general partnership, and over the course of the next 5 years, they distribute back to me $500,000, then my liability with the firm, with that company, if it goes bankrupt or whatever, is limited to $500,000. The remaining difference between what I had originally put in and what distributions I had already received. Okay, so the liability as it associates with the limited partnership aspect is simply limited to whatever remaining equity those limited partners have within the company. General partners, unlimited liability. Okay. And then we have corporations. This is probably what everyone's most familiar with. If you were to start a corporation, you know, XYZ Incorporated, right, unless you elect what's called an S Corp, right, you're automatically assumed to be a C Corp. All right, and what does that mean? We'll talk about it here in a second. The difference between S Corp and a C Corp. And then we have limited liability companies, right? Like my firm, Phoenix Financial Engineering, it's an LLC. All right, I run it, I manage it, but the liability, if I were to get sued for malpractice, all right, is limited to the equity within the firm as a whole. My personal assets, everything, you know, my house, my car, my own personal bank accounts can't be touched. Okay. Now there's probably a point at which it could get touched, but in general speak, limited liabilities are essentially relating to the assets within the firm itself. And everything is what's called pass through. So every dollar that kind of comes in the door, you're able to take, you know, all of your business expenses off of that revenue, just like a normal firm would. And then whatever is kind of left over flows to the managing member, the owners of the business, and then it's taxed at whatever their personal income tax rate is once the funds flow there. Okay, so SPs, right? Some advantages and disadvantages, and all of these have them, right? But it's the easiest to start. It's the least regulated of any entity. You as the single owner, you can't have anybody else owning it with you. It's just you. That's why it's sole. All right, one person. Right? You keep all the profits. You're responsible for maintaining all of your expenses. And then whatever's left over gets taxed at the marginal tax rate that you fall into as a result of whatever's left at the end. Okay. And for those of you that took my 121 class, you'll remember marginal tax brackets. Right? But within corporate America, all right, the Tax Cut and Jobs Act under the prior administration from a personal income tax standpoint, and let me see if I can find it here. I'll show you kind of what it looks like. And while I'm talking, all right. It used to be that the corporate tax structure was built in a very similar way to how we get taxed at our personal level, which is what's called on a marginal tax basis. And I'm just kind of looking it up here real quick. There we go. Over. But the Tax Cut and Jobs Act under the prior administration changed the corporate tax structure from a marginal to a flat. So you guys are lucky, because a couple of years ago, you would have had to go through this giant rigmarole. So for personal tax filers, right? So for you and for me, like when we go do our filing and, you know, we shove all of our numbers into TurboTax and TurboTax says, hey, you owe $2,000 to the federal government. This is kind of how it's done. So if you're filing single, the first $10,275 of your income gets taxed at 10%. The next increment, so if you make more than $41,775, the difference between the 10,275 and the 41,775, that entire bracket gets taxed at 12%. So you're creating these layers of taxes, right? And this is how the corporate tax structure used to look like as well. On your personal income taxes, that's how your total tax due or owed is calculated. If you make $100,000 a year of taxable income, well, the 100 falls within this range, okay? So the first $10,275 is taxed at 10. This whole bracket gets taxed at 12. This whole bracket gets taxed at 22. And then finally, 100 minus this gets taxed at 24. And all 4 layers get added up, and that's your total tax that's due. But with corporate America, all right, now the tax rate is a flat 21%. All, doesn't matter how much revenue your firm generates, it's all taxed at 21%, which makes our life in this class a whole heck of a lot easier, right? So disadvantages, right? If you're a sole proprietor, your business ends when you die, right? It can't get transferred to anybody else. The capital is limited to your personal wealth. You assume unlimited liability, but depending upon what product you might be selling, there may be no liability, okay? And it's dang near impossible to sell your ownership interest, because essentially if you're a sole proprietor, all of the equity in the company relates specifically back to you, and it's extremely difficult to value an individual person's worth to the sales of a company. It's extremely difficult. Okay. Partnerships, all right? So we talked about general partners and limited partners, but partnerships where you're involving 2 or more owners. Typically, you'll be able to have access to more capital, like with the banking system, right? The more people you have involved, the more credit is involved. The ability to pay is improved because you're not just dealing with one person's ability to pay. Now you're involving a group of people's ability to pay, which gives you access to more capital. It's super easy to start. Literally, like you can go onto the Department of Labor website, fill out a form, and you can have your business ready to rock within probably 60 minutes. Okay, it's really easy to start. Your income gets taxed once as personal income, so very similarly to the sole proprietorship. Now with partnerships, you can choose to take distributions from the partnership. You can elect to take personal income, which are 2 different things. We're not going to get into that in this class. But so depending upon how you receive your income, okay, it gets taxed at whatever your personal tax rate is. Disadvantages. I got to fix this slide. I'm going to make a note real quick. All right, disadvantages, unlimited liability. All right, like we said, general partners have unlimited liability. They're responsible for managing the businesses day to day. All right, so they have unlimited liability. Within the limited partnership, your only liability is related to the amount of remaining equity you have within whatever firm you've invested in. Okay. The partnership, it's a legal agreement between two parties. Okay. Those two parties can be individuals. All right. Like whatever. Garrett and Mary decided to go start a partnership, and they build their business, and all their legal documents relate specifically to their two names. Well, if one partner decides they want to get out, if Garrett decides he wants to sell and go do something else, that partnership has to be dissolved, and a new partnership has to be established between Mary and whoever she chooses to bring in for the next portion of the partnership. Okay, so it kind of dissolves when one partner dies or decides to sell out, which is one of the reasons why it makes it a little bit difficult to transfer ownership of partnerships. Okay, corporations. All right. Corporations are interesting, right? There's a couple of Supreme Court cases there at the bottom, starting back in 1809 and finally getting into 1853 with Marshall versus B&O Railroad, where the Supreme Court has said and has provided corporations with this person distinction. Corporations are people, okay, which means they can be sued, all right, for the purposes of court jurisdiction, right? They're considered to be citizens, right? And the shareholders within those corporations are considered to be citizens of the company's home state. So if a company is headquartered in North Carolina, right, and for whatever reason, like the shareholders get sued or the shareholders want to sue the company, then those shareholders, whether you live in Alaska or Hawaii or Texas, they're considered to be citizens of North Carolina for the purposes of court jurisdiction. Okay. So the advantages of a corporation, they have unlimited life, right? CEOs get hired and fired, board of directors get swapped out, but Kimberly-Clark remains as a corporation into eternity. Okay. They have the advantage of having a separation of ownership and management, right? Shareholders and board of directors, right? The transfer of ownership is easy, and it's a lot easier to raise capital because the entity as itself has created its own credit worthiness. Okay. Disadvantage, all right? You see the same thing here, separation of ownership and management. Why is that both an advantage and a disadvantage? Well, when managed properly, it's an advantage because when you have the will of the people, if you will, the shareholders, okay, who are kind of voting and deciding on the direction of the company, okay, and the board of directors approving that, right? If the board and the company follow through, then what they're doing delivers extra value to the firm, which then delivers value to the shareholder and therefore becomes an advantage. The problem becomes the disadvantage, which is what we call the agency problem, is when there's a disconnect, okay, between the decisions that the shareholders and the board of directors make and the direction that the actual company is going, right? If management, okay, the CEO and the management of the company are making decisions that simply put money into their own pockets, or they make boneheaded decisions about what projects to implement that destroy value for the firm, now we start to have conflict, okay? And this is where the agency problem comes in, and we've got a little slide to chat about that. The other disadvantage is we got double taxation, okay? This is a big problem with corporation, where because the corporation is a person, that it's an entity, right? As we build the income statement for a Netflix or Microsoft or formerly Activision or Tesla or whoever you want to look at, AT&T, as we build the income statement, right? We get down to the very bottom part of the income statement where it's time to pay Uncle Sam that 21%, right, of EBT. Right? So that's tax number one. And then we get down to net income. Okay. And so now management says, hey, we got this net income left over. What do we do with it? Well, you got two choices. Actually, a couple of choices, but it all involves this. Do we keep it all for ourselves? Right? Do we keep all of our net income for ourselves and flush it to retained earnings on the balance sheet? Or do we take some of that net income and do we pay it out in the form of a dividend to our shareholders? And then flush whatever's left to retained earnings. That's next week's conversation. Okay. But nonetheless, when we as shareholders receive dividends from companies, we then have to pay tax on the dividends that we receive. So hence the double taxation. The firm pays tax, and then if they issue dividends, we as the shareholders then have to pay tax on those dividends. Flows onto our IRS 1040. I think line 3B, whatever it is, ordinary dividends on line 1040, 3B. All right. So there are some advantages and disadvantages for each and every one of these, and they all come with consequences, right? So if you want to set up a corporation, it's going to cost you a little bit more money. You got attorney's fees, right? You've got board of directors that you have to bring together. You have to keep minutes of your mandatory corporate meetings that you have to have, right? So there are costs associated with selecting the type of entity that you would like to create for your firm or whatever firm you're going to go work for. Right. So hopefully in the next 15 or so minutes, we're going to get into the McGee Cake Company, okay, which is on Moodle. And we're just going to have a conversation around what type of business model, capital structure should the McGee Cake Company look at implementing. Right. So we talked about the three questions that we as financial strategists, financial managers, the three questions that firms who deploy capital have to answer. So what should the goal be of the corporation? Okay, you can hit the chat room, you can unmute yourself, whatever you want to do. Let's just have a little conversation here. What should the goal be of a corporation? Maximize profits? That sounds good. But which profit? Gross margin? Net income, EBITDA, you'll learn it. Minimize costs, maximize market share. What do we think? What should the goal be of the corporation?
Maximize shareholder value.
Oh man, you guys just jumped ahead on the slide, didn't you? Daggone. No, it's a great job. That's exactly right. Okay. Each one of these, right? If we do all of this, if we maximize profits, if we minimize the costs that we have to incur to generate revenue, right? And we conquer the market while maintaining our gross margins. If we do all of these things, what we're really doing is exactly what Jeremy said in the chat room. The entire goal should be to maximize shareholder value. Every decision that we make, every decision that you're gonna make, whether, and again, what you don't have to be in finance. And how many marketing folks do we have out there? Okay, as we progress through the first part of this semester, you're going to probably start asking yourself, what does this have anything to do with like the marketing job that I'm going to get in the future? But I'm going to bring it back to that. Right? I'm going to show you why, no matter what field of work that you're going to go into, the entire goal of every decision that you make is going to be to maximize shareholder value. Because if we do that, we accomplish all of this. If we do this, right, we generate more revenue. Okay, we negotiate better contracts with our suppliers, lowering our cost of goods sold, which means that our gross margin then goes up. And then on the cost side, we minimize the costs that it takes to generate all that revenue. That means we maximize EBITDA, both from a profit standpoint and an operating expense standpoint. We maximize EBITDA. And if we maximize EBITDA and we've injected new assets into our business properly, we get to take the benefit of depreciation. And depending upon how we chose our debt versus equity financing, we get a deduction on our income statement for the interest that we pay on our debt. All right. And then everything flows through all the way down to net income. And then net income is what allows us to decide, do we keep it all for ourselves to grow, or do we pay some of it out in the form of a dividend? And next week, we'll talk a little bit more about why companies do pay dividends, why some don't pay dividends, advantages and disadvantages of doing that. Okay. But bottom line, and you're going to hear me say this time and time again throughout the whole semester, the bottom line, the singular goal is to maximize shareholder value, period. Okay. Shareholder value, not management value, shareholder value. Now, management might be shareholders through the form of stock options or stock grants or RSUs or whatever. Okay. But the goal is to maximize shareholder value. Okay. So now that we've said that's the goal, does this mean that we should do anything and everything to maximize owner wealth? Right. So this kind of gets back to, it relates to like what's legal versus what's ethical. You know what I mean? So if we have a company, it's based in the United States, and our goal is to maximize shareholder value, right? And we're presented with an opportunity to outsource our IT department to a different country, right? Does that maximize shareholder value? From a pure numbers standpoint, if you're able to get the same level of service and it's costing you less, and you're not sacrificing any revenue because of that change, and it's maximizing shareholder value, then yeah, I guess from a pure numbers standpoint, that makes sense. But then it gets into the conversation, well, shouldn't we be employing more people within our home country? Okay, so the globalization or versus non-globalization aspects of finance, right? Because globalization started probably, I don't know, 30 plus years ago. Like back when I was in business school, like that was the entire, like all the case studies dealt with globalization and the impact of globalization on local economies and country economy. Okay, and whether it was good and whether it was bad, or whether there needs to be a different balance. So outsourcing versus offshoring. So there's a difference. What's it? Anybody know the difference between outsourcing and offshoring?
Offshoring is where you locate your company in like international, like you put it in Ireland, but you operate in America, versus outsourcing is where you're getting labor directly out.
Exactly. Good job, Hunter. That's great. Okay. And then you've got, the company. So I grew up in living in Houston when Enron was like the company that everyone wanted to go work for. And I was also living there when it completely collapsed. Like I literally, in probably like late February, early March timeframe was when all the Enron traders would get their big bonuses. And I'm talking bonuses like $1 million+ bonuses. And I was working in a chemical plant just south of Houston. And me and buddies of mine, every year, we would grab our lunch and we'd go sit out in front of the Enron building in downtown Houston and watch as Lamborghinis, Bugattis, Ferraris were just delivered in trucks and placed out in front of the Enron building because all the traders had bought their new car for the year. And it was unbelievable. But if you go and you do some research and some learning about Enron as a company, it was completely, the wealth of Enron was completely made up, right? And it was designed to simply make the people at the top really, really rich. Okay, so we'll talk a little bit more about that as we go through the semester. But the question is that should we do anything and everything to accomplish that goal of maximizing shareholder value? And I contend the answer is no. I contend that there is some ethical commitment that we have to wherever we are operating in order to not sacrifice everything for the sake of money. Okay. Some people may have different opinions on that. True, like real true capitalists would say, yeah, do it all for the sake of maximizing shareholder value. I said that there's a point at which you have to not do that. Okay, and be okay with that. Which creates what we call the agency problem. All right, so within the agency relationship that exists within corporations, we have principals, okay? And the principals, they hire the agent to represent its interests, right? So as shareholders, as stockholders within a company, we are the principals, okay? It is our job to hire the managers, the agents to run the company. Now, as shareholders, we're not the ones going out and hiring, the mid-level accounting manager specifically, right? But our job is to hire the board of directors. Okay? As a shareholder within the company, you have that right. You get that right every time a position on the board opens up. You get the right through what's called a proxy statement to vote on who you want to be on that board. Or if you want somebody fired, there's a lot of activists that are out there. What's the guy's name? Einhorn from Einhorn Capital. You know, there's a lot of George Soros is another good one. But they have a lot of influence. You know, when you hear about corporate board takeovers, where they will take over a board and fire people off the board, right? The principles, we as shareholders, we as stockholders, we hire the managers, and the managers, AKA board of directors, are responsible for running the company. Okay? But this can lead to what we call the agency problem, right? Where we start to get a conflict of interest between the principal and the agents, right? Where we as the shareholders have elected this board of directors, and the actual physical management of the company is going in a different direction than what the people that we have hired have said that they need to go. Okay. One of the big one is executive compensation. Okay. Gets us back to what I was leading into 30 minutes ago with the agency problem. Executive compensation, right? How do you think, what do you think one of the largest components of, say, Tim Cook's executive compensation package is?
Stock options.
Okay, stock options. All right. Right. So if the stock price of Apple exceeds the strike price of the option that he was receiving, then he would exercise and he makes his money. Right. But if the stock price doesn't, he doesn't exercise it and they expire worthless. Right. So there's a risk there. But yeah, stock options are a component to his executive compensation package. Bonus. Okay. All right. So Lexi says bonus. All right. So what is one of the ways that Tim Cook's bonus could be larger? Ceteris paribus. So business is running and he gets a bonus tied to what? His bonus is either larger or smaller, depending upon what component. Yeah, Jeremy.
One of it would be the share price. So if the share price increases, he'll get a lot more money.
Okay, stock price. All right. Theoretically, right? Conceivably, if Apple starts the year trading at $135 and it ends the year trading at $190, we have delivered value to the shareholder, right? We have done things within our business to maximize profits, to minimize costs, and we have added value to the firm. And that incremental new value is reflected in the larger stock price. Okay. Now, this was probably in 2016, right? Gabrielle says extra compensation for upholding the company's interests. Yeah, I'm sure that that is a portion of his executive compensation. Sure. Maintaining the values of Apple, the presence of Apple within the marketplace, maintaining the values of the company in front of the customers. Yeah. So it's like 2016, David Einhorn. Apple was just about to start figuring out how they were going to spend. At that point, they had it was probably like 135 or 140 billion dollars of cash in their business. They have a hell of a lot more now, but back then that was still a lot of money too. That how they were going to spend the money, how they were going to spend the cash, right? And so one of the ways that they actually wound up spending the cash was they repurchased shares on the market, okay, as a way to deliver value. Now your question probably is, well, how does buying back shares change the stock price? It's just math, okay? It's just math. And we're going to talk about that a lecture later on. But one of the key components is what's called earnings per share, okay? And we have another ratio called price to earnings ratio, which we'll talk about in 2 weeks. And that relationship between the number of shares that we have in the market and our stock price and how that relates into the price per earnings ratio, PE ratio, we're going to come back to this agency problem, because when we buy back shares, we're taking shares off the market, which artificially inflates our earnings per share. If our earnings per share goes up and we're trading at the same price to earnings ratio, then price to earnings ratio times earnings per share gives us stock price. And so, agency problem. Did Apple, was it truly in the best interests of the shareholder for Apple to spend those billions of dollars buying back shares versus the other option is to reinvest back in their business for possible growth? Okay, and that's where David Einhorn came in. He's an activist investor through Einhorn Capital, basically challenging Tim Cook's and management's decision to spend money, to spend capital to repurchase shares because of this potential agency problem. Okay. Was the shareholder really going to be the one to benefit, or was it just benefiting the C-suite and board of directors? Okay, here we go. All right, again, so we just had this conversation: managerial compensation, corporate control, potential activist takeover if there's a disconnect between management and the principals. Right. You guys I would encourage you to go do this. All right, some of the words that I just threw out there: price to earnings ratio, earnings per share, what the dividend yield is, right? These are all important things that we'll spend a lot more time talking about over the next 15 weeks with each other. But oddly enough, Yahoo Finance is still like one of the best places to go to get data on companies that you might be looking at investing in. And that's about all they're good for. Okay, but they still have a really good finance site. Morningstar is also another great one. That's what I use for my firm. Right. And as Loyola students, you guys actually have access to the same Morningstar that I have access to, that I have to pay like $5,000 a year for. You guys have free access through it through the Notre Dame library. So I'll put a link to that up on our Moodle page. But if you are interested, you get access to all the research, all of the data that doesn't exist on just like the Morningstar.com free site. Okay, so when we think about cash flow, we're gonna harp on this for kind of until the midterm probably, right? When I talk about cash flow, I'm referring to cash flow from a financial management standpoint, right? Not the accounting cash flow. Okay, so we're not even going to have a conversation around the cash flow statement, the GAAP cash flow statement in this class. We're going to talk about cash flow the way that financial managers see cash flow, okay, which is not the same way that it's presented on the cash flow financial statement that the accounting departments produce. Okay, so it's a very important distinction. Right? So how do we look at the way cash kind of moves through a corporate entity and between the financial markets that we're going to access in order to finance our operations, debt or equity? Right? So when a company goes public, all right, within the primary market, okay, they access the equity markets through the primary market. Shares get issued, shares get sold. The funds from that sale, that initial sale, the IPO, all right, flow into the firm for the firm to then deploy in order to maximize shareholder value. Okay, so the first step is the firm issues securities and cash flows directly into the firm as a result of that. Okay, then we use those funds, right, to invest in assets for the firm. Okay, what we call NFA, net fixed assets, or sometimes we'll call it PPE, plant, property, and equipment. Nonetheless, we're using these funds to invest in assets for the firm. Okay. And within those assets, we have current assets, right? So things like the cash that we might retain. We have accounts receivable. We have some inventory. Okay, so current assets. And then we have long-term assets, or what we call fixed assets, the assets that we use, okay, in order to generate revenue. And so when we use those assets, both current and fixed, right, we bring cash into the business in the form of what's called cash flow from the firm's assets. Okay? And starting next week and then the week after, we're going to get into what do we mean by cash flow from assets? Because it's a component between sales as well as interest that we've paid or new debt that we've taken on, or the value of our equity within the firm, right? So this is a difference between cash flow from assets, our cash flow from assets from a financial manager standpoint, versus what the accountants would say cash flow looks like. So we generate all this cash flow, right? So we have all this money that we've generated from the operations of our business. And then we have some decisions to make, right? If we have debt that we've taken out, right, to finance our operations, well, we owe interest to the creditors. Right? If we have a dividend payout policy, well, then we owe money to our shareholders. And then we kind of have, maybe we have the government in the form of taxes. We got to pay taxes. And then we've got whatever's left over. And then whatever's left over, we call that the reinvested cash flows. Right? That flows back into retained earnings for the firm that we can then use to generate additional revenue or purchase additional assets in order to generate even more revenue, okay, or more profits, I should say, net income. Right? So this is kind of how the flow of cash moves through the firm, within the firm, and also as it also touches on the debt and equity markets. Okay, so this is what we'll start next week, kind of getting into the nuts and bolts of. So when firms access the equity markets to go public, to IPO, right, they're accessing what's called the primary market. All right, you're not going to be tested on this. It's just general knowledge for you. So primary market is the IPO market, right? We, as average investors, we want to go out, we want to buy, whatever, you want to buy synthetic crypto, fine. But that's done on what's called the secondary market. All right, IPO markets are primary markets. And then once things start trading, that trading happens on the secondary market. And you're familiar with the NASDAQ and the New York Stock Exchange. All right, if you're dealing in derivatives, okay, options trading or futures, or you want to purchase a front month bushel of wheat, okay, you're going to be dealing with usually what's called the CME group out of Chicago, and it's the world's kind of leading derivatives marketplace. And when we get to the futures and options conversation towards the end of the semester, we'll go through all that. I'll show you what it looks like. Pretty fascinating. Any of you guys know that you can trade the weather? Pretty cool. Pretty cool. You can trade whiskey. You can trade cigars. It's insane kind of what's out there that you can actually trade. Now, it's not very liquid. There's not a huge market for like whiskey or cigars, but you can do it. Pretty neat. But that leads us into some other problems. And when we get to like that conversation, we'll probably go back and we'll watch a little bit of like there's one clip that I absolutely freaking love from the movie The Big Short, where I guess the guy's name is Gyllenhaal. I forget his actual name, but he's explaining kind of what happened with the entire financial market crisis and the meltdown. And it's like 3 minutes long, but it is, the greatest layman explanation of what happened back then. But it deals with derivatives. Okay, so that is all that I wanted to get into in terms of just the intro for our class. Does anybody have any questions, comments? I'm going to stop sharing here. Any questions, any comments? No. I also, let me see. I think I closed it down. I do have a YouTube channel. All right, where I've got some previously recorded lectures on the topics that we're going to be discussing, for the course, throughout the course of our time together. So, and I'm also going to do my best to record all of our lectures as well, to have them up there too. But in case I don't, like when we get into the data detective simulation in a couple of weeks, there's a whole video like 8 minutes long that talks about what we're going to be doing. Okay, so you'll be able to, yeah, go ahead, Nita.
Hi, Professor. Can you hear me?
I can, thank you.
Okay, great. So thank you very much. So my question was, back when we were talking about the different types of businesses, I remember when we were talking about a sole proprietorship, thinking about, taxing, you can get taxed as personal income. My question is, for people who are, let's say you're, for example, you're a high income earner, for example, and you want to start, a business. Would you think that, so if you're somebody who's like a high income earner and you're thinking about starting a business, would it make more sense to kind of lean away from a sole proprietorship, or does that really kind of depend on, other factors or the full picture of what that business would look like?
No, and that's a great question. And the answer is yes. So if you're a high income earner, let's say I'm just looking at the tax brackets here, okay? And let's say you make $165,000 a year. All right, which is the 24% marginal tax bracket. Okay, so you've got a job that's already paying you $165,000 a year. Okay, and you wanted to start your own business, right? And let's say that business brings in $20,000, right? That $20,000 flows directly to your income, okay? Which would take your income from 165 to 185, right? Well, now you're no longer in the 24% marginal tax bracket. Now you're in the 32% tax bracket because it pushed you into that next tier. Okay, so yes, you kind of have to be strategic as to what type of corporate structure you're going to have, especially if you're a high income earner, and especially if your new business is not your primary source of income.
All right. Sure. Thank you.
Sure. Anybody else? Kevin, did you raise your hand? Go ahead. Can't hear you, bud. Oh, he's typing. Okay, cool. Anybody else while Kevin's typing? Okay. All right. So I hope I didn't scare anybody off. All right. It's a fun class. There's a lot of things that you're going to learn throughout the course of our time together this semester. There's going to be things that you don't quite understand that I am more than happy to help clarify. Okay. But just please reach out. Again, we're in grad school. You're probably not going to get an email from me going, hey, are you understanding everything? Okay. All right. I will be more than happy to meet a number of you in class beforehand, get on the whiteboard, go through things. There's a lot of learning that can happen outside of the classroom as well. Okay, so if you have concerns or you just want to talk about something that may have happened in the market, and we're going to talk about that too, some technical analysis. We're going to get into Bollinger Bands and what's called the moving average, convergence, divergence. You're not going to have to calculate it, but you should at least understand what it means and how we can go about seeing the way money moves into and out of different equities. Okay, Kevin, here we go. For SPs, can a family member inherit it to prevent the business from disappearing? No. Okay, the business itself terminates when the sole proprietor passes away. Okay. Now there's probably some contracts that can be drawn up and all of that would allow it to kind of continue, but Kevin Pan's sole proprietorship would end upon your passing. You could call it something else and put it into an LLC, and then you could pass it along. Okay, so I put on Connect. I went ahead and just kind of put some practice problems from chapter 1. All right, nothing crazy. Like I said, this week is pretty easy. If you've got questions about the course, please feel free to hit me up via email or text me or call me or whatever. But I'm happy to visit with you guys. Okay. Otherwise, have a great rest of your day, and I will see you next Tuesday.
Thank you. You have a good one.
All right.
Thank you.
Serve you well.
Thank you very much.
Thank you. Thank you.